Good morning, everybody, and welcome to the morning call. My name is Pete Renzulli, Chief Marketing Officer at T3 Live, as well as Class B member at T3 Trading Group. Filling in for Scott Redler this morning, and for Mark as well. Wishing Scott luck on his test next week, and wishing Mark and his family healthy birth of their new baby today. So good wishes all around for everybody. Friday morning, end of the week, end of another short week. We just had a couple of chaotic weeks, I guess, with the Eve and the holiday falling in the kind of in the middle of the week. Next week we get back to kind of what I guess we would call a normal week. There has been some opportunities. Obviously we had the fiscal cliff stuff end, and it was really just a question of how you traded it. To have a gap and follow through, which is something that we haven't seen in a while, is very, very interesting, and we're still kind of hovering above that level. I want to point out something on the charts first before we actually get into some individual stocks. I just want to get into a little bit of trading planning stuff. It's, we spend a lot of time on resolutions and that kind of stuff, personal-wise, and I think that far too many traders, in my experience, which is going on 12, 13 years now, far too many people give their trading plan and the clarity of their trading plan a little bit too much of an afterthought. And in my experience, the more obvious and clear your trading plan is, the easier it is to understand what you should or shouldn't be doing. So if you have not done so already, we posted two 25-minute videos on the website. If you go to the video page on the website, you'll see them, and there's a two-part video about lessons from the mentoring room from 2012 that you could take into 2013. And we go through quite a bit of stuff of mistakes that were made that would be removing from your trading, and stuff that worked and putting it into your trading. So it's definitely worth sometime over the weekend taking about half hour, 45 minutes, taking a look at those two videos. And tying that into the first chart that I want to look at, I want to take a look at the VIX and explain how your trading plan should be a part of how you adjust your trading based on the overall volatility of the market. So if we can cut to the chart here real quick, I'll show you. You can see here clearly the VIX has had almost a 40 to 45% haircut over the last 3 days. Now, how does that affect your trading plan? Essentially what happens is, as the VIX rises, that essentially means that the average true ranges of stocks on a day-by-day basis, which is the range from low to high average on an intraday basis, will increase. So as the VIX is traveling higher, intraday you're going to get wider ranges. Wider ranges to risk the same dollar amount essentially means that you have to lower your share size to risk the same dollar amount, because you probably have to have a little bit wider stop loss. So when the VIX takes a big hit like that and it starts to come down, volatility contracts. So once you're risking the same dollar amount, you're probably going to be able to trade a little bit bigger share size to compensate for the fact that you're not getting the wider swings. So a part of your trading plan has to be, what is the volatility in the market right now, which will dictate how many shares you can trade based on how much you expect the market to fluctuate. So as the VIX rises, in my opinion, you should lower your share size a little bit to compensate for the wider volatility. As the VIX comes down, again, probably close to a 45% haircut over the last few days, you could probably increase your share size a little bit per trade because you're not getting as wide a swing. So just something subtle like that to add to your trading plan to help you maximize when there is opportunity. So we get into the charts right now. We have some pretty decent ideas, both long and short today. We'll start out with the long side, and we'll actually start out with the spiders. Interesting setup here on the low that we took out a few days ago. When we got to 140, reversed, gapped up after the fiscal cliff. This level here was the one that I've been watching. I wasn't sure if we were going to get through there. I actually attempted a couple of times to get short up in that area, and we seem to be holding. The longer we hold this gap up and do not retrace and fill that gap, the more likely we're going to end up retesting these levels up here. So the next level that we're looking at is the level from October, which is right around 146.32. So we're in one of those situations right now where the long is a little bit aggressive because of how far we've traveled in such a very quick period of time. But the short sale in a lot of these ideas is not necessarily a great idea either, unless those stocks were already in downtrends. So you have to make the distinction between a trade where you can definitely manage the risk versus a trade that has a high probability for follow-through. It is a massively different thought process. And I see it all the time in the mentoring room, and I've seen it over the years, and I've actually done it myself. You must be saying to yourself right now, managing the downside or seeing a stop loss on a stock that you feel has gone too far to the upside. In other words, I see that I can get out, no problem, versus I want to be long and there's a really good probability of it going up. It's not the same trade. So I can manage the downside versus I have a great idea is not the same thing. So if you're looking to short some of these stocks that have traveled and you might feel they're overbought a little bit, you might be looking at some one-to-one risk-reward ratios at best here. So you want to make sure that you skew it a little bit more in your favor. And you don't have to trade all the time. Trade when you feel like you have a good edge and the risk warrants the reward potential. So if you feel like if you're risking $1 to make $1 because of how far some of these stocks are extended, wait for some patterns intraday, whether it's on the 15-minute chart, 5-minute chart, whatever it happens to be. At least if you could see a spot intraday that you could manage in the direction of some of those trades. And I guess the first one we're going to get to is I want to go to First Solar. It's trading a little bit lower this morning, but this is kind of the one that interesting. We took out a pretty decent level yesterday. When I left my desk, it was trading just around 33, which was the breakout area from here. You want to be waiting for some of these stocks that have extended to pull back and looking to bid intraday levels. If they've moved a decent distance over a very short period of time, you don't want to be the person who's chasing price. You want to be bidding levels that you can manage the downside. So looking at this stock here, this is in my game plan yesterday, and there was a couple of other stocks that moved a much stronger percentage in this particular sector yesterday, but you need to know as a trader, should I be buying breakouts or should I be buying pullbacks in strong stocks? And the further along they get extended to 3, 4, 5 days in a row, or percentage-wise have moved a decent distance. You can see here this is almost $6 in 3 days. You want to be knowing whether or not you should be buying as soon as they take out the new highs or waiting for a level to pull back intraday and let the intraday moving averages to catch up. So this one here intraday is already pulled back to the 33 level. I'd be looking to bid this because that was the support level. Next, we'll take a look at Apple. Very, very interesting. I think what a lot of people are looking at right now in this stock, we have essentially a triple bottom down here. It has not been able to crack 500 with any sort of gusto. As a matter of fact, it didn't even break it. I think the low as it got was 502, if I'm not mistaken, 501.23. So what's going on here now with the stock? A huge part of the community watches this, and everybody that I get emails from is, what is Apple doing? What do you think about Apple? Is it time to get in? From a short-term trading perspective, I'm looking at this gap fill right now. We've gapped up, obviously, on all the news, and so far we have not filled the gap. What I'm looking for in this stock is to pull back maybe around the high of this 536 level, which would also coincide with the 8 and the 21 EMA. If we hold that level, if we get what might call a hammer or a doji in that level, and we start to see some price persistency, where maybe we get 1, 2, or 3 days to the upside, not just one day, but a couple of days, then you could start to dip your toes in. But I want to be very careful about this. If you're new to trading volatility of stocks, whether it's Amazon, Netflix, whatever it happens to be, where the ranges intraday can be anywhere from $5 to this one, I think, if I'm not mistaken, is like $16. It's very, very important as a trader, whether you're a short-term trader or a position trader where you may be holding stuff for a quarter, build a position. Work the trade as it moves in your favor, and don't take unnecessary risk until the trade starts to prove itself. Now, if somebody had asked me about this trade in the mentoring room, I would say, I understand your thought process, and if you're going to do it, it would have to be on your list of a B or a C trade and not an A trade because of the longer-term downtrend. I understand why short-term traders want to get involved in downtrending stocks that have rallied for a couple of days, but you have to put the scenario in the perspective of where the order flow is. It could be turning around with the triple bottom, but we're still pointing down. So if you're going to be aggressive on a trade that is not an A trade, and an A trade, Scott would call it strategic or portfolio approach, versus what Scott might call a tactical trade, or Mark might call cash flow, you have to know that you're trading against that higher time frame, and it's extremely, extremely important to build a position because it's not an A trade. Now, we also get asked quite a bit, how does a stock go from your B or C list into your A list? Well, that means that you are now trading with obvious order flow, which takes it to another thing. What time frame are you looking at for your obvious order flow? If you're trading off 15-minute charts and maybe hourly charts in Apple, you probably can justify you have an uptrend right now. You probably can. But the shorter the time frame you're getting your trend, the lower the edge. The higher the time frame, you have more money and more time that it takes to move that trend. So just be aware of that. It's not necessarily wrong, but it's also not necessarily an A trade here. So you could start to build an argument. Triple bottom, got above the moving averages, gap higher with the rest of the market. You could start to see that you might be able to start building an argument here, but be diligent about building a position on the long side until Apple becomes an A trade. Next interesting one that I want to take a look at that has been out of favor for a while, and I guess we'll take a look at the weekly chart to get an idea. You can see hewlett-packard here topped out, double top at 55, rolled over at 50, and then start to zoom down on the daily chart. We have what we call here a capitulation once and twice. Now, the interesting thing here is the second time, you can start to see a lot of shares were dumped, and the stock did not continue to the downside, and we're starting to rally a little bit. This is a pretty significant rally. We held the moving averages, now we're gapping up again. And we've also cleared this 1450, 1475 level. This is starting to become a better trade right now. The downtrend that has lasted for roughly 18 months is just about to be broken. Now, you set alarms, you set buy stops, you do 100 shares, however you ultimately want to do it. Everybody's share size and tier size is different. It's one of the most popular questions that we get. This is a stock that is starting to turn and see different type price action. When you start to get bigger pushes to the upside against and finally breaking through a long-term downtrend, it's something that you want to pay attention to, because as the stock starts to roll up, not roll over, but roll up, you could start to see some institutional buying in this area here and decent intraday ranges for a stock that's $12, $15. So keep an eye on hewlett-packard possibly breaking it. It's one of those that pulled up on my scan for volume and price action and a pretty decent move off the low. So as long as we stay above the 1450 level, I think you're okay there. eBay next. I like eBay, but I don't like it unless it stays above 53. Clearly, really solid uptrend going on for about 6 or 7 months now. We pushed above the 53 and immediately got rejected. Now, that's a big thing you want to see. You do not want to see push through, come back, and come right in. In order to have conviction, which is what we want in all of our trades, you need to know what you do want to see. If you get a nice move in your direction, you want to see a nice little flag or a pause or a pennant or something along those lines. If you get a push up and then an immediate reversal, especially if it happens on decent volume, which yesterday did, over 10 million shares, be a little bit more diligent, again, to notice that something happened different. And something also happened like that in Lulu. Lulu pushed through to new highs and hit basically a double top, maybe a triple top there, 78, 79. And then the next day, we actually had a huge reversal on big volume. And again, big volume is relative to each stock. So you come into the day and you're looking to say, okay, it pushed through, could not get through, and all of a sudden now 78, 79 is a level we're having a hard time getting through. Home Depot had this with 52 for a while. Starbucks has had that with 50, 52 for a while. Whatever stocks that you're watching, you have to do a lot more looking than just what it did yesterday. You know, we all run scans and what stocks were up the most yesterday, what stocks, you know, all that kind of stuff. But sometimes you have to put the bigger picture in perspective and keep it as simple as something as it's having a hard time getting through 78, for argument's sake. That might be the right price for the stock. And now it's actually trading down pretty decent amount this morning. I think when I left my desk, it was down a couple of bucks, if not more than that. So you have to put it's like reading music. I'm not a musician, but you have the whole song and you have the notes, and you have to know both of them together to get the spirit of what's happening. And some stocks, you can clearly see it has a hard time getting through a level, and right now this is the level for Lulu. So we had something similar. I believe it was in Monsanto, no, Schlumberger actually, where it was actually slowly grinding higher, and then we had this monster reversal day. It wasn't a big down day, but we had big volume on a day where it closed below the open when it should have been based on the previous price action going higher. So just give yourself a chance to do a little bit more research on the charts in the stock than just what happened yesterday and just where it is relative to the moving averages. Netflix is another one. I do like Netflix, but we're also, again, we're looking at a double top here. We want to see it take out this top and hold above this level. Obviously, 100 is the next level. It's been very interesting since all the news that occurred at the end of October. We have actually been holding those levels. So as a technical trader, you want to use the news as a catalyst, but ultimately you want to manage the trades from a technical perspective so you can manage the downside and set some projections or targets. And right now it's holding here. So if we can get above this 97, 98 level and push towards 100, you have some room to the upside there. Some interesting ones, Goldman Sachs holding above 130, which actually, if you can see on the weekly chart, actually we'll go out to the monthly chart, 130. Pretty big level here. We have a nice little 5, 6, 7 month trend. If we push through here, we're looking at 140 and then 170. So you got some room in Goldman Sachs. The longer it stays above 130, the more I like it above that level. Same thing with Citigroup. Gap up, held so far while holding. It doesn't matter how big the ranges are. Right now we continue to gap. We had a gap here, gap higher opening here, and another one here. 4 gaps in the last 5 or 6 weeks. Regardless of what you think about the system, regardless of what your opinion is on financials, they're slowly grinding higher, and the gap higher without fills. That's a pretty strong statement from the market and for those individual stocks. All right. A couple of other ones. I have United Technologies actually advancing very well. Had a really nice breakout from this level. Failed the first time, and now we gapped up and we're holding. As long as this one stays above 82.75, 83, I'm going to be looking to be long that stock as well. Boeing, same thing. Boeing finally broke through 76. You can see really, if you look a little further back, again, doing a little more research, We finally punched through this level, which was 75. We danced around it for a little bit, and now we're above it again. So I'm looking to stay long Boeing, or I'm not in the trade, be long Boeing or above, as long as it stays above 75. Another one, interesting, TSO. I don't normally trade this stock, but it came up on the scans, and it looks very, very interesting from a big double top perspective. We had this really nice run during the summertime, pushed up, tested 43.75 again and again, getting back to what I said about a stock getting to a certain level and either liking it or not. This time we're not having as deep of a pullback as we did here in October, and the longer we stay above this level of 43-ish, 44, I do like this for another move side. So game planning the stock, push up sideways is what I want to see here. The longer it goes sideways and stays above that 43 level, the more I like it for another push higher. We're going to take a look, a couple of stocks on the shorts. Actually, I want to mention 4 stocks that are usually off the radar, but have had some really interesting moves over the last 3 or 4 months, and it's Ford, GM, UAL, and DAL. We'll take a look at these charts here. Here's Ford. You can see a really nice head and shoulders bottom there over the fall. Actually, it's the summertime. Staying very comfortably above the ADMA. A little bit overstretched right now, a little bit of increase in volume, which is what you want to see on the spike. We're probably going to have to let the moving averages catch up a little bit. But you can see again here clearly 1150 was the price. Finally punched through 1150. Now I'll be looking for it to pull back a little bit. General Motors, same thing. Really, really clean move above 26. Finally, you can see here again, just eyeballing the chart and say that's the right price until it gets out of this range. There's nothing to do. Finally did, gapped up prior to all the fiscal cliff stuff on good volume, and we seem to be staying above. Again, so now you have to be saying to yourself, is it overbought a little bit? Probably. Let it catch up and look for a move in a strong stock. Classic technical analysis, trade the market leaders that are strong if you want to be long. Right now these guys are bouncing, and we'll go to DAL and UAL here and get the same kind of picture. DAL finally got above the $12 level, had a really nice flag here after the push higher. Look at that perfect textbook volume decrease on the flag, and another push above. As long as it stays above the 12, we're okay. And UAL, same thing. I'm actually short a little bit of UAL into this resistance level here. I'm looking to start to work a position, but again, getting back to what I said before, DAL has some room to go, UAL has some resistance here, so it's not necessarily an A sell short, so I'm working it a little bit more into the resistance, keeping the thought process of that's been the price it hasn't been able to get through, so that's the price I'm going to be monitoring at. I feel like it's a little bit extended, so have a scenario. Right or wrong, you need to know your A trade, trade management, B or C trade, trade management, tactical cash flow, whatever you want to call it, portfolio approach. In this case here, it's not strategic, it's into resistance. It's actually a trading range going on a bunch of months. So we have the last 6 weeks, and then we have the last 7 or 8 months, and now we're coming up to a price that hasn't been able to get through. I just want to touch on a couple on the short side that are interesting. First, we're going to take a look at is GG. I actually started to look at the stock, saw some accumulation down here, and I thought we were bottoming out a little bit for a move to the upside when we got above the 8 and the 21, but yesterday we got rejected right down again. So I'm looking at this stock on the short side again this morning. I nibbled a little bit on the long side yesterday, didn't get hurt, it wasn't that much size, didn't follow through. Next we have DL and DG. All right, DL actually, I'm sorry, it's not DL, DLTR, excuse me. DLTR, nice little trading range here. This is, again, you need to set your alarms to know what stocks have room to go. Right now, the stock's trading 38 to 42. I like it below 38, but it's got to close and flag below 38 based on the fact that it hasn't been able to break it in almost 2.5 months. But I do like the downside there. The other one is DG. You can see DG did have an intraday reversal, but clearly in a downtrend on all the charts. So as long as it stays below the 43 level, that's an area that I'd be looking to stay short looking for 40 to be the next target. Last but not least, UNH. UNH had a really nice breakdown, finally out of that big pennant. You can see if we draw a trend line from here to here, we finally broke down. Actually was short this yesterday. A little bit aggravating if we could, I don't like to go to the intraday charts too much, but if you could take a look and see what it did intraday, it was actually sideways for about 4 hours yesterday before it finally broke down, so patient paid yesterday a bit. So I guess really overall, the bottom line is this. The VIX just got almost a 40-45% haircut, came in from 20-something down to 14 and change. 15 is usually the area where it'll settle in and get there. As the VIX decreases, you could probably get away with trading management perspective, increasing your share size a little bit to compensate for the smaller intraday ranges, assuming you want to risk the same dollar amount. And as far as the market's concerned, look, fiscal cliff or not, technical trader or news trader, we gapped up, we held, we're holding above that level right now. We have not pulled back that much, if at all. Matter of fact, yesterday we just kind of a consolidation type day. I'm expecting a little bit more volatility based on the fact that we held the range yesterday. So we're looking for the highs of December to be the benchmark for whether or not we can get a little bit more aggressive on the short side, and then ultimately looking to see if the VIX continues to push down. So game plan properly. If your stocks are far too extended, here's the big thing with the intraday trades. If you're a short-term intraday trader and you're watching this and your stocks have extended 5, 6, 7 days in a row, or they moved a very, very good relative percentage to the upside in a very short period of time, in my opinion right now, the prudent thing is to be buying the pullbacks as opposed to be buying the breakouts. So give yourself a good spot to manage the downside and manage your risk. All right? Have a great weekend, everybody, and have a great trading day.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.